There is a piece of paper, you've signed it. Most people sign it every year without reading past the rent amount and the move-in date. It has 2 lines for signatures. One line is yours. The other line belongs to someone who understands the document completely differently than you do. To you, the lease is permission to live somewhere. To them, it is an income stream with your name attached to it. This is how that relationship changes, completely minus, depending on which side of the document you're on, and how the entire industry treats you differently at every level of wealth between the 2 signatures. Level 1, the application costs $50. You pay it before you know if you'll be approved. The landlord runs your credit, your income, your rental history, your references. He takes 3 days to decide whether you are acceptable. You have no equivalent information about him. You don't know if the boiler is 2 winters from failing. You don't know if the building has an open code violation. You don't know if the previous tenant left because of mold or mice, or a landlord who stopped returning calls after the lease was signed. The information asymmetry is total. You sign anyway because the alternative is starting over. The deposit is 2 months' rent, $3,400. You drain the account to pay it. The account that was supposed to be the beginning of something else. Move-in day, 3 things don't work. The bathroom faucet drips, the kitchen light flickers. The heating vent in the bedroom blows cold. You text the landlord. He responds 4 days later, says he'll have someone look at it. Nobody comes. You text again. He responds with a thumbs up emoji. The faucet drips for 11 months. Your lease renews. The rent goes up $180. Not because anything improved. Because the market moved, and you are easier to keep than to replace minus as long as the increase stays below the point where leaving becomes worth the effort of leaving. He has calculated this precisely. You haven't. At the struggling renter level, the landlord's entire strategy is based on one asymmetry. He knows exactly what it costs you to leave, and he prices accordingly. Level 2, you make more now. The apartment is nicer. The building has a gym. The landlord is a management company, not a person minus a logo on a portal, a ticket system, a 48-hour response guarantee that is sometimes honored. The lease is 12 pages. You read 2 of them. Inside the pages, you didn't read a clause that allows them to enter with 24-hour notice for any inspection, a clause that defines normal wear and tear so narrowly that repainting becomes your liability, a clause that auto-renews unless you send a certified letter 60 days before expiration to an address in a city you've never visited. The deposit is $2,800. When you move out 2 years later, buddy tied, $600 comes back. They charged you for the carpet. The carpet was already 3 years old when you moved in. You didn't photograph it on move-in day because nobody told you to. You dispute it. They send you a PDF. The PDF has a clause. You stop disputing. At the stable renter level, the landlord is no longer a person minus. It's a system. And the system has been optimized for decades by people whose entire career is closing the gaps between what renters know and what the lease says. Level 3, you bought a place. Not as an investment minus as a home, then life moved you somewhere else. The job, the relationship, the city that made more sense. And instead of selling, someone suggested, why not rent it out? You said yes without understanding what you were saying yes to. Month 1, the tenant pays late. Not 30 days late, minus 11 days late. You check your account every morning. You don't know if you're allowed to charge the late fee. The lease you downloaded from a template site says you can. You're not sure if that's legal in your state. Month 3, the tenant texts at 11 p.m. The garbage disposal is broken. You spend 45 minutes on YouTube learning how to diagnose a garbage disposal. The repair costs $180. You're not sure if this is your expense or theirs. Month 7, you get a letter from the city. There is a required rental inspection. You didn't know rentals required inspections. There is a $90 fee. There might be violations. If there are violations, there is a timeline to fix them or a fine. You are managing a business you didn't train for. The income is $1,400 a month. The hidden costs minus the vacancy, the repairs, the property management fee you eventually pay because you can't keep doing this, minus eat $600 of it. The net is $800 a month before taxes. Before taxes, you're a landlord. After taxes, the accountant explains that you need to understand depreciation, Passive income rules and Schedule E. You pay the accountant $400. The real estate investing content you watched made none of this visible. At the accidental landlord level, you discovered that owning property and profiting from property are two entirely different skills. Level 4. 3 properties now, you bought them with intention, you read the numbers before you signed, cap rate, NOI, cash, on cash, return. The vocabulary of someone who treats real estate as math, not as shelter. The tenants pay on time because you screen them like a system, not like a hope. Credit check, income verification. Rental history, previous landlord call, minus not email, call, people lie on paper. They hesitate on the phone. You have a property manager. She costs 8% of gross rent. She is worth every dollar because she is the buffer between you and the 11 p.m. garbage disposal text. The property's cash flow $2, $800 a month, combined after all expenses. Not passive income, minus that phrase is a lie, told to sell courses. It's income that requires less of your time than a job, but more of your attention than a savings account. You refinanced the first property last year, pulled $60, zero of equity out, used it as the down payment on the fourth property. The bank lent you money, secured by an asset you own to buy another asset. You used debt as a tool for the first time consciously. Your tenants are paying down your mortgage. Every month, a portion of their rent becomes your equity. They don't know this, you do. At the intentional investor level, you understand something that took most people years to articulate. You are not in the housing business. You are in the cash flow business. The houses are just the vehicle. Level 5, 10 units. Not 10 buildings, minus 10 units across 4 property. The number matters because 10 units is the threshold where things change. Below 10, you're a landlord. Above 10, you're a business. The IRS treats you differently. The banks treat you differently. The insurance companies treat you differently. The commercial lender calls you, not the residential mortgage department, minus commercial lending. The conversation is different. They don't ask about your credit score first. They ask about the property's income. If the property pays for itself, your personal income is almost secondary. The asset qualifies, not you. This is the moment most people miss. The shift from being personally underwritten to having your portfolio underwritten. Your name on the loan matters less than the cash flow statement of the properties. You have a team now, property manager, accountant, attorney, insurance broker. These are not expenses. They are the cost of running a business that generates money while you are not in the room. The portfolio generates Pudon 8,500 a month net. You reinvest $5, zero of it. The other $3, 500 is a salary you pay yourself from assets you own. The concept of trading time for money starts feeling like someone else's problem. A tenant breaks a lease. 6 months ago, this would have cost you sleep. Now it costs you a phone call to the property manager and a month of vacancy you'd already budgeted for. At the portfolio builder level, the problems didn't disappear. They became smaller relative to the infrastructure you built around them. Level 640 units. You don't manage properties anymore. You manage the people who manage properties. The distinction sounds small. It isn't. Managing properties means answering to tenants. Managing people means answering to numbers. The numbers are a monthly report, occupancy rate, average days to fill vacancy, maintenance cost per unit, rent collection rate, net operating income across the portfolio. If the numbers are right, you don't need to know which faucet dripped. You have a full-time property manager, an administrative assistant, a maintenance coordinator who has a network of licensed contractors who show up because there is enough recurring work to be worth showing up for. The banks compete for your business now, not your personal business, minus your portfolio's business. A regional bank calls. They want to finance your next acquisition. They offer 4.8%. You mention you've been speaking with another institution. The rate becomes 4.5%. The price of money dropped because you have enough of it that losing you costs them something. You sit in a room with a commercial broker. He brings 3 off-market deals. Off-market means the property was never listed publicly. The seller called him directly because he knows you're a serious buyer. Serious buyers close. Closing is worth more than the highest offer to a seller who's tired of deals falling through. You get access to deals that don't exist for anyone without your track record. At the operator level, the real estate industry doesn't treat you as a customer anymore. It treats you as a counterparty. Level 7, the conversation changed, not the industry minus the conversation. At every level below this one, you were acquiring, buying, adding units, growing the count. At this level, you are allocating capital. The distinction is philosophical and financial simultaneously. Allocating capital means you decide where money goes at a scale where the decision itself moves markets. A FADOL, 40 million acquisition in a mid-size city doesn't just add to your portfolio, minus it changes the rent comparables in that zip code. It changes what other landlords charge. It changes what renters pay. You are no longer inside the market. You are part of the mechanism that sets it. The deals come to you now. Investment banks, private equity contacts, developers who need an equity partner with operational experience. They bring opportunities that require minimum investments. Most people will never touch minus, and they bring them to you. Because your track record is the credential that opens the room. The conversation about tenants happens once a quarter in a board meeting. Occupancy, retention, average lease duration. Not names, not dripping faucets, not $50 application fees. Numbers that represent thousands of people who are living inside assets you own. The lease still has 2 signature lines, but the distance between your signature and theirs is now measured in buildings, not apartments. You remember the tinaithi, 3,400 deposit you drained your account to pay. You remember the faucet that dripped for 11 months. You remember the thumbs up emoji. And somewhere in a building you now own, there is a tenant who just texted a property manager about a dripping faucet. The property manager sent them a thumbs up emoji. You don't know this. The system is running without you now. There is a piece of paper. Someone is signing it right now. They read the rent amount. They read the move in date. They drain their account for the scanty deposit. The other signature line belongs to someone who understands the document completely differently. The distance between those 2 signatures is not intelligence. It is not luck. It is not access. It is the moment someone decided to understand which side of the lease creates the income minus, and then spent years building toward being on it. That moment happens at every income level, at $35, 0, and at $350, 0. In a studio apartment and in a boardroom, the lease doesn't care who you are. It only cares which line you signed. The question was never whether you could afford the deposit. The question was always which signature you were building toward.